This is Talking Capital Markets, where ideas drive the markets. We move past the headlines and into the heart of the deal, breaking down IPOs, M&A, governance, and the strategies driving real growth in today's capital landscape. No noise, no hype, just conviction, execution, capital in motion. If you're building companies, raising capital, advising boards, or deploying investment, you're not just listening, you're in the room. And now, here are your hosts, Mike Blankenship and Brian Jue.
Welcome to Talking Capital Markets with Mike and Brian, your go-to source for insights about the intersection of finance, law, business, all around the capital markets. And the capital markets is actually a big market because you're talking about all kinds of companies at different points in their life cycles and different facets and different types of mechanisms. There's a lot here. We always have a lot to talk about. I'm Brian Jue, and as always, my incredible co-host, Mike Blankenship. How are you today, Mike?
Doing well, Brian. Good to be with you and talking capital markets and what we're kind of seeing the market today on various things.
Absolutely. And one of the things that we're hearing a lot about, I know it's come up with you a lot, myself, and then even just this week, a couple of deals that you and I are talking about, this topic's come up, and it's direct listings. And there's a lot to unpack. There's differences, and there's, just like a lot of other things in the capital markets, one person will define it as one thing and someone else might define it as another. And we try to help everybody sort through everything. It helps when we've got someone like Mike Blankenship, top-notch A1 attorney, runs the capital market practice for Winston & Strawn. Mike, jump in, talk to us about direct listings.
Yeah, so direct listings, there are three real ways to go public, generally the big ones, right? You've got your traditional IPO, which we've talked about numerous times. You've got your SPACs, so the special purpose acquisition companies going through that way, which is another way of like almost a reverse takeover, which is kind of like a fourth way, but not really as popular. So people use the SPAC market to go that. And then you have your third one, which we'll talk about today, which is direct listing. So direct listing is essentially, filing your company under the 33 Act, which is the Securities Act that's the offering. It's registering certain shares for sale, usually existing shareholders. You do need a prospectus. So you do a form S1 and you don't have an underwriter. That's the key. So no one's underwriting securities of your company. You have financial advisors. So they're advising you on various things. And what we typically see is companies go out, and whether it's in the micro cap or smaller space, will have a valuation done by a third party. And typically NASDAQ wants, the rule requires $100 million minimum valuation, but they usually want to see a couple $100 million valuation because they're going to peg that price to it. Oftentimes other ways the price is done when it's going out trading, you've already been approved, is a price discovery through the exchange of an auction. So you go on the exchange and they kind of look at that price. So we're seeing a lot more of that. I think the audience, the ones that they would know that are kind of famous ones that were via direct listing, big ones, are Spotify, Coinbase, and Slack. So those are big companies that were done that way. But you also have small ones. And so a lot of the smaller ones have done it. We've certainly represented and they'll have a bridge maybe to help them finance kind of going in or capital at the end. And so the direct listings, a very popular way of doing that. And they do it on the Form S1. Now, there's also another option, which is doing it on a Form 10, but that's not registering any particular securities at all. So you don't have any coming out on the float. So you have a different way. They just become a Exchange Act reporting company and then can be listed. Form 10s are a little different. They automatically become effective after 60 days. The reason I bring this up is because I've had conversations with a particular regulatory body. And I think, you have the question of, will we have more listings if they were under Form 10 versus a Form S1, if there was some way to reduce liability to do that or have them on there. And I think, doing more companies, and we talked about this before, there's, roughly 3,500 U.S. companies listed from the heyday of 9,000 25 years ago. And, there's probably about 14, 15 or a little bit more foreign private issuers. So you don't have a lot of tons of companies out there. And so if you could get more listed, have more of that democratizing, putting more on there, I think it'd be nice. So I think direct listings are an interesting, appealable way. I was just at NASDAQ with one of my clients ringing the bell that had gone through that process, which is a lot of fun. I will tell listeners here, being part of an exchange, being part of something like that and watching your company kind of grow and hopefully having that public listing will do that. That's my view on it. I was a long way there, Brian, but try to pack it all in for you.
No, that was fantastic. And and help me out here, Mike. I mean, like a lot of the stuff that we hear about, people will bring up a topic, a term, methodology, and make it sound like it's something that's brand new. Versus a lot of times it really is just rebranding something that's existed that just fell out of vogue. Right? Direct listings have existed for some time. It's just changed over the years. And help me out. I believe that it's one of the reasons why we don't see as many of them or hadn't before is that the smaller market maker that used to exist that would often sponsor a direct listing, maybe not underwrite it, but sponsor it, do the 15C, that type of thing. A lot of those firms are gone. We don't have a lot of those firms anymore. And so now, with how they have to happen now, what are some of the other steps? I mean, yes, you don't need an underwriter, but for someone that's looking to do a direct listing, what do they need? What are some of the professionals that they're going to have in their world?
Yeah. So it's counsel to help draft. You've got accounting group to help with financials, auditor to do the audit. And those are the main advisors. And you have obviously the financial advisor we talked about. So those are going to be ones that help them kind of look at it, maybe get the cash. So, doing the S1 style is different. If you did a Form 10 style, maybe you do a pipe at the listing or some sort of ATM after listing if you could. So, a lot of these will get into, different types of financing to get there, the cash they would need to be, because again, it's not a underwritten offering. So there's no cash particularly there. That's not to say that if you had a large enough company or one could go out and do a primary offering on the direct, both NYSE and NASDAQ have allowed that. But I think we see, less of that, more of a pipe style that goes.
Something that I always thought is that a company that can really benefit from a direct listing is something that already has a recognizable image, persona, perhaps, direct to consumer, something that's front facing to a lot of people and that people know what it is and what it's there. How do you feel about that?
Yeah, I think if you have that retail presence or have that knowledge, people could see it. There is probably some of that. I mean, you look at the ones that I mentioned before that were direct listings. People know Spotify; they listen to music on it, or they know Coinbase because they've bought crypto on that exchange. You know these companies, and so it's a lot easier. Or they use Slack at works. Those are ones people know, and I think people are probably interested. Oh, that's going to be a successful company. I want to invest a few dollars into it. You do get that retail uplist, lack of a better word, a way to kind of help elevate the status of it, and so you get more of it. Because a lot of times, smaller companies, kind of to your point about market makers coming out of it, you also don't have research on these companies until they reach a $500 million valuation. Research is critical because some institutions won't invest in a company until they have research coverage. So, the big mutual funds, the pensions, all of that won't invest unless there is that. So there's like a minimum threshold to meet. I think having that retail there can help drive the valuation, can help drive the product, the company itself. So I do think it's an important piece.
No, that makes a lot of sense. Yeah, I think for a lot of companies, they have to understand that there are options. There's always more than one option, right? The other thing that I think a lot of companies fail to understand sometimes is they're looking at the IPO as an exit when it's really like what we're talking about here. It's a liquidity event, yes, for some, absolutely, but this is a way to find and get the growth capital necessary to really launch the company and take it to another level so that there could be a secondary or another liquidity event down the road.
That's right. It gets them there and have the ability to do that pretty quick.
Well, this is great, Mike. It's always great talking to you. Another fantastic episode of Talking Capital Markets with Mike Blankenship. I'm Brian Jue. Thanks again, Mike.
Thank you, Brian. It's been a pleasure. Our next one.
Talk to y'all soon.